Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years as a graduate at MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Carolyn, thanks very much. Our goal every month is to look at the latest economic numbers and see what they mean for real estate. This month, we can also take a broad look back at the last year to give us some idea of what this next year will look like, even though the pandemic is still with us. Here's one way to see the national economy. The blue bars show what's happened with retail sales, and the red line shows the very large loss of jobs. We can see that to some extent, people are again spending money as they did before the pandemic. At least some people are. The red line, on the other hand, shows that the recovery in jobs has stalled around 6%, which means that 10 million people probably are not spending very much. This remains the two-headed monster of the 2020 recession. Many people doing fine, but also a large number with problems that will last well into next year. Here's another way to see the economy, which shows how far we still are from a normal level of growth. The chart shows the change in gross domestic product from the same quarter of the previous year. We're getting there, but so far we are still in the red. Both views of the economy strongly suggest that economic turbulence will continue through this year and probably into the next. Now let's have a look at how the recession has affected the real estate market. The big news is that home prices at the end of 2020 were 6% higher than the year before, something that I, for one, did not expect. Price increases had been slowing well before the recession. And in a recession, you don't usually see strong home buying, even if interest rates are low. But in 2020, the number of owner-occupied homes increased by 6 million. Here we can see the dynamics of that change. The chart shows millions of homes. Added owner-occupied homes are in orange, renter homes in blue, and vacant homes in purple. It's clear that 2020 was not a normal year. In a normal year, about 1 million new homes are built and sold in the US. So where did the other 5 million homes come from? 2 million came from turning renter properties into owner-occupied properties, and 3 million from the inventory of vacant homes. A lot of people wanted to buy a home, and not many homes were on the market, so prices went up. And the big question is, was this a one-time deal, or will there still be strong home buying this year? As an aside, I'd like to think that 2 million former rentals were bought by people who were renting them, but we don't know that. One thing we do know for sure is that there are now fewer rental properties right at a time when more people, for financial reasons, will need to rent. So 2021 will be an interesting time for real estate investors. To better understand how demand for housing will evolve this year, let's have a look at the various sectors of the economy. Here you see in greater detail the percent of jobs lost compared to last year. It's the same as the red line we saw before. After improving quickly, that loss is now stuck at 6%, 10 million jobs. We know that some of these jobs are gone for good. Stores and restaurants that closed, businesses that do more work with fewer employees, local governments that have cut their budgets. This situation will not improve until the pandemic is under control, maybe by the end of the year. But even then, with many of the old jobs gone, there will need to be new jobs. More government spending on infrastructure would be a good start. This is one reason why more government help is needed. Construction jobs came back pretty well at first, as old projects were completed, but we now need investment in new projects. In manufacturing, job recovery has hit a wall as well, and this clearly is also a field where government policy could provide a huge boost by bringing crucial manufacturing jobs back home. In retail, the situation is more bleak from the job point of view. We already saw that retail sales are doing well, but jobs in retail were flat even before the recession. So we'll see no boost in this sector. The numbers in this chart, by the way, include all the new jobs at Amazon and other online retailers. Recovery in business services jobs has been slow but steady, although it also seems to be stuck right now at 3%. This is one of the biggest sectors of our economy. When jobs and business services go positive, I'm willing to declare the recession over, but not until then. Healthcare is another big part of the economy, and unfortunately, the financial pressure on hospitals and doctors' offices is leading to more layoffs, maybe permanent ones. The healthcare sector is largely a private sector and has to match expenses with revenues, which are way down. Restaurants are one of the largest employers of people who have few other options. Note that the scale in this chart is 3 times bigger than in the other charts. The loss of jobs has been massive. The good news is that people like to go to restaurants, and once the pandemic is controlled, they will do so again. But until that happens, probably not until early next year, the people who held these jobs will have severe financial problems. Just a few more slides and we're done. Jobs in government belong mainly to teachers, clerks, bus drivers, police, firefighters, who are a mainstay of many communities. But local governments can't borrow money from the bank. If they don't have revenues, they have to cut their workforce. That's what we're seeing. And there will be profound effects if local governments can't get back on their feet. The finance sector is smaller than most of the others in terms of jobs, but very important to real estate markets because the average pay is high. It's also the sector most heavily computerized, and therefore it's lost relatively few jobs. But even here, we see that the improvement has come to a halt for now. The pandemic is still in charge in all parts of the economy, and the economy won't recover until it's over. It's as simple as that. The last slide is my private recession indicator, jobs in computer systems design. These are software engineers who make a lot of money. Because they're expensive, companies only hire as many as they really need. So when they start needing them again, it will be a sign that normal growth is back. All of this information affects the real estate markets. Jobs drive demand for housing, for homes, for rentals, but other forces are at work too, such as those that drove home prices higher. Will the dynamics reverse in the next year as personal finances recover? Will the rental market fracture into a high end that does well and a low end that does poorly? Or will the middle of the market be the safest refuge for investors? I lean towards that view, but it's one of the things we just won't know until we get there. It's a time of opportunity for investors, but also for risks. To finish, let me plug our investors metro analysis, which shows how local conditions down to the zip code level will affect investments in real estate, especially rentals. It's available for any of 200 markets and is easy to use as 1, 2, 3. It's especially useful during uncertain times like these. Thanks very much for following along. This is our National Economic Outlook. I'm Inga Windsor.